Which super fund should you choose? It's a big decision because performance and fees do vary, and over the long run, these things can have a significant impact on how much money you end up with in retirement. So in this video, I want to explore what you need to consider when choosing a super fund to set yourself up for success later in life. Now, before we get started on talking about how to work out which super fund is right for you, it's important to keep in mind that not every superannuation fund is suited for every period of your life. It's not uncommon, and I see it all the time, that Australians have one super fund when they're younger, one super fund when they start contributing a lot more, and another super fund when they retire. The key here is that the superannuation environment and the superannuation industry in Australia has lots of choice, and that personal choice is key in finding the fund and structure that's best suited to you and your objectives and your values and exactly what you're looking for. Now, the first type of super fund I want to talk about now is called industry funds historically, and now known, they used to be called not-for-profit, now they're called profit to members. What that means is that they seek to reduce costs. When they seek to reduce costs, they reduce the fees and the investment fees that are charged to their members, as opposed to a corporate entity like an AMP or something similar, where the higher profits can be distributed to shareholders as the companies are publicly owned companies or listed on a share market. So interestingly, industry super funds used to be the cheapest superannuation option, but this isn't necessarily so anymore. As a broad example, Australian Super and ART both charge an administration fee of 0.1% of your assets every year. Both have a cap of, I believe, $350 and $100, but they also charge an investment fee of 0.52%. and 0.59%. It's a very similar average across most of the industry, and these are solely investment fees. One of the issues we have with industry super funds is they have a limited number of investment options. Interestingly, industry funds tend to have a much lower member base. So looking at some of the information available from the APRA, the Australian Prudential Regulatory Authority, which regulates superannuation funds, the average balance of a MySuper account, so that's a default superannuation option issued by an industry fund, is just $71,000. And the average balance of a choice superannuation account, where you get to choose your fund, is $136,000. Interestingly, further is the fact that, as Connexus Institute, a think tank, pointed out, the average age of industry fund members is around 44 years of age. They are also subject to something called the Your Future, Your Super legislation. So because you're defaulted into an industry fund, they are required to track their performance against a benchmark and indexed approach that is set by the government. And this is because there was such a large range of good and bad returns above and below the index that they were concerned that disengaged members and retirees were investing in a fund that wasn't performing and had no reason to leave, and they weren't really receiving enough information. So in this case, if your super fund is underperforming the index, there is the potential that they could stop taking on new members if they did that for an extended period of time. This is what has driven massive consolidation in the industry fund sector, and also the increase in a number of funds that have either $200 or $300 billion, including Australian Super and Australian Retirement Trust. I think what's interesting about this is that by benchmarking and forcing these funds to now focus on what the index is doing, it's actually forcing them to track the index more closely and have less room to take risks or to invest for the longer term or to add alternative asset classes, which has been one of their biggest benefits historically. Now, the pros of industry super funds is that they have had solid returns, albeit mixed. The top fund is very different to the bottom fund. Interestingly, and despite the ads and marketing, the 7-year return from the industry super fund, the 7-year median return from the industry super fund sector is about 6.8%, for 5 years at 6.5%. So it's solid returns, but it depends on which fund you picked, and not every industry fund is doing well. Another benefit is they've invested heavily in unlisted assets, things like private equity, like venture capital, like infrastructure that you can't buy on the share market, and large properties. And this has been a great diversifier. Whether that is the case in the future is a completely different question that I can't answer. Another benefit is they're set and forget. They basically offer you outsourced investment support, and you don't have to worry about it. You get 2 statements a year, and you basically can only make one decision. You don't even need to make that if you're defaulted into a fund. They offer an expanding range of investment options. So a risk profile option like a balanced or a balanced growth or a growth, a single sector option like Australian shares or global shares, and also some DIY options that offer you the ability to have a little bit more control. And naturally, as I said before, one of the benefits is the fact that any profits they make are supposed to be used to reduce the fees that you pay. Now, what are the drawbacks of an industry super fund. One is that the fees you're paying are only for investment management and essentially for intra-fund advice. That means they can only tell you what to do around contributions or around switching investment options within your fund, and very general, as opposed to meeting with a financial advisor where you can have a whole retirement plan, financial plan built, reviewing multiple super funds, outlining strategies, and also modelling your situation for the next 20 or 30 years. They also offer some transparency into the holdings of the option, but not into your specific holdings within your superannuation fund. And this is because super funds invest in a pooled structure. That is, your money is pooled with everyone else, and you're buying units into this one large balanced growth structure, which also means you inherit everyone else's tax position. If they're turning over those investments more, you're going to get more capital gains, or you're going to pay more tax within that investment, give or take, whether you're in income mode or pension income mode or in accumulation phase. You also have limited control over your investments. So while the offers are expanding, there is still very limited, as few as 10 to 12 investment options in most cases. More recently, we've seen issues with death benefit payouts and insurance, but ultimately you have very limited access to individual people and customer help desks. A lot of your engagement with an industry super fund is going to be online via an app, via chat, and very little ability to talk to a person in most cases, given the size and the fact that some of these funds have 1.5 to 2.3 million members. Similarly, you have limited flexibility for strategic and estate planning. So if you want to make contributions and draw a pension, you'll have to have multiple accounts, and estate planning can be limited by what the trustee allows. So who's an industry fund suited for? Generally for a less engaged person, generally for a younger person, and generally someone with a lower balance, and someone that has little interest in investments or doesn't quite yet have questions around where their money is invested and how their portfolio could be managed better. Now, the second type of super fund I want to talk about is a corporate super plan, and there's two types here, and we're going to stay with the second type. One is an employer determined super plan, something like Plum or Mercer, for instance, and these can be very similar to industry funds in terms of a limited menu. But what we're going to talk about today is the advisor determined super fund, and that is something like AMP, Netwealth, Hub24, Colonial First State, and these are very different industry funds in that you have much greater control over the investments, and importantly, they're usually the next step or graduation from industry super funds as retirees or Australians get more engaged with their money. If you're looking for advice on your super strategy or want more control over your investments, this is the first step, and this is something that's used heavily by advisors for a number of reasons. Talking about that, the benefits of advisor-initiated platforms are the fact that you have complete transparency over every single investment. You have the ability to control decisions, so what combination of ETFs, of stocks, of funds, what ethical views you want to execute across your portfolio. You have control of all of these with support of a financial advisor. You have the ability to access financial advice and execute that advice via these platforms, and to include your other assets rather than just your superannuation. So on a platform, you can invest a trust, a personal account, a superannuation account, SMSF, anything you like. Much greater investment selection, greater flexibility on tax planning and estate strategies, and also the ability to subsidize financial advice through investments. So a lot of financial advice is focused on managing a portion of your investments, but the benefit you get from ongoing financial advice, a lot of that actually comes from strategy and reviewing your financial plan each year, keeping up with contributions, legislation changes, estate planning, all those sort of things. Using a platform allows you to access that while subsidizing that via a fee across your investments. In comparison to the likes of an SMSF, platforms offer the ability to have reduced paperwork and reporting. You don't have to report to the tax office, you don't have to complete financial statements and tax returns. And in most cases, the fees on a platform cap out at anywhere from 1 to 2 million, depending on who your advisor is and what platform you're working with. The costs have come down significantly for platforms in recent years. What are the drawbacks of investing in a platform? The biggest one is the cost is that platform fee, and this can be anywhere from 0.1 to 0.2%, and it's quite broadly in line with the percentages charged by an industry fund, albeit the cap is generally much higher than an industry fund. There can be some limitations on the investments you're able to use, subject to the trustee allowing them, but in most cases you're looking at access to 800 to 1,000 to more investments, and in particular the ability to invest across multiple asset classes, including overseas shares, overseas ETFs, and wholesale, so more sophisticated funds that aren't available as an industry super fund investor or investing yourself. The other drawback is that generally platforms can make money on cash balances. That is, the interest rate you receive will be less than what you could get in a bank account, but there are ways to get around this by investing in other high-yielding bank accounts or other investments that have a higher income. And probably one of the biggest drawbacks is that performance is up to you and your advisor. So this control that you get comes with responsibility, and the responsibility to make good decisions with your retirement capital. So what type of person is an advisor-initiated platform appropriate for? In this case, you're looking at balances from anywhere from $500,000 upwards or even slightly lower. But most importantly, starting to get engaged and active and need to execute some more assertive superannuation strategies. So that is, we might be more actively contributing. We might want more transparency into our investments. We might be worried about where the market's going and want some input into that. But most importantly, we're starting to invest heavily for retirement, and the percentage-based fees in an industry super fund are starting to increase and getting more expensive. Now, the third type of super fund we want to talk about is a self-managed super fund. This is historically the domain of business owners. So small business owners, the ability to own your own business property in a self-managed super fund, rent it to yourself. That was a big reason for this part of the industry getting started. And all these super funds are subject to the same laws. But super funds, SMSFs, are basically you becoming the trustee as opposed to Australian Super, as opposed to net wealth, that you as an individual become the trustee of your own superannuation assets and the ability to control them. Interestingly, according to the ATO, the average balance of SMSFs in financial year 2023 per person was $835,000, and the median age of new establishments was 47. But the average age of SMSF members was 63. So there's been a lot of growth in SMSFs as people seek more control and as the costs come down. Generally, they're suited to people with high balances. And why is that? Well, in retirement, I found that people want to know more about their investments, and they have a lot more questions than they do when they're saving money, focusing on paying down the mortgage. So in order to answer those questions, you need transparency and you need control. The pros of an SMSF: one is the fixed administration costs, usually around $3,500 a year. All you really need to do if you want to run an SMSF is complete a tax return and have financial statements and have bank accounts and the normal structures set up. In return for that, you get complete control over your investments. You can hold whatever you want with very limited restrictions. You can hold residential property, you can hold shares, ETFs, overseas shares, commercial property, a very broad range of investments. And as your balance goes up, that's clearly one of the benefits that people see in this. You have complete control over the fees. That is, if you don't want to engage an advisor, you don't need to. If you want to invest in only index funds, you can. If you want to avoid unlisted property, you can. It's all up to you, and you can control the fees and the investments. You can see every underlying investment. You have the flexibility to implement the same contribution strategies, but to do it more efficiently and effectively, and also the ability to include your children in your superannuation fund and help with that estate planning strategy at some point in the future. One of the more less appreciated benefits of a self-managed super fund is the fact that you can have both an accumulation and pension account within your superannuation fund at the same time without having to apply for a new accumulation account every time you start a pension, as you would in a platform or in an industry fund. And the drawbacks of a self-managed super fund: the fixed cost of that $3,500 or so means it can be expensive on lower balances. The control comes with more paperwork and involvement, and obviously more risk. So the performance of your self-managed super fund is based on your decisions, so you are ultimately responsible for what happens in your retirement. It could be very different to the alternatives you could get: an industry fund, a platform, and this is why so many self-managed super fund trustees engage advisors to help them build their investment strategies. It can be difficult to diversify your fund if you've got a smaller balance, but as that balance gets bigger, you can actually use a platform via your SMSF to get a broader range of investments. And there are some legal restrictions on transfers, strategy, and investments, but most of these are around ensuring that you're not breaching the sole purpose test of superannuation, which is the fact that your super assets are there to generate a retirement income, not to transact in residential property or to hold assets that you have personal use of. That's the big part of those restrictions. Who are they suited for? Generally suited for, more so for retirees, more so for those with larger balances, and definitely those who are more engaged with their investments, want to know where every dollar is invested, and also want to get the best taxation position and control their tax that they're paying on their superannuation assets. If you want to know which super fund is best suited to your situation, our advisors are more than happy to help. The key takeaway from this video being that not one super fund is suited to everyone forever, and it's important to constantly review, assess, and reconsider every investment and every superannuation account that you have. Now, please follow this page, please comment, please reach out if you'd like any advice or have any questions via the YouTube channel, via our email, or via social media channels.